Good morning. This is Axel Merk, President and Chief Investment Officer of Merk Investments, and I am here with my now third live update on the markets. I want to use this opportunity in these unusual times to give my take on things. I'm navigating here different screens, so pardon me if I don't always look into the camera. I want to talk about the equities today. I want to talk about the policy response and about gold a little bit, since there's a lot of demand about gold, talk about gold and gold mining. So let's first talk about the markets. Obviously, I'm not telling you anything you don't know. Futures are down quite a bit. S&P is down quite a bit as I talk. The Dow Jones is down 850 points. Yesterday, we were in a quote-unquote bull market again, since we were up 20% from the lows. We are obviously in extremely volatile times. The definition of bull and bear markets are somewhat arbitrary. In my experience, in a bull market, things move up and up and up and up, and then sometimes you have a sharp correction, and then you move up and up and up. In a bear market, it's kind of the opposite, where you tend to move down slowly, and then you have these sharp rallies. Now, some people pointed out, well, don't you have also just high volatility in general? Yes, absolutely. Especially in the early phases of a bear market, volatility tends to be highly elevated, and that's kind of an understatement of late. And so, by all means, but the short of it is, to me, this is a bear market rally. Clearly, this isn't investment advice. Anything I say here is not investment advice, and so forth. To just while we're at it here, I have to in between show a little bit of disclosure, so might as well get this out of the way. Please read that. The normal course is in any recession is that it is isolated, it's localized, it is some particular issue, and then you realize, oh my God, there are ripple effects, other industries are affected, something else. Now, what is, of course, there are several things that are most unusual about this. One of them is that the US economy never has had a supply shock causing a recession, especially not in this particular fashion. It is usually on the demand side that things start to falter because the consumer is exhausted or some other things. But there is really, as far as I know at least, and please correct me if I'm wrong, no historic precedent in the US for this sort of adjustment, which also should tell you, you should take it with a grain of salt. Anybody tells you, including me, that is, of course, because we simply cannot know for sure what is happening. So before I talk about the policy response, some more things about the markets. Today is a more classic risk-off day. You have, for example, the Japanese yen is the strongest currency in the major currencies. The quote-unquote good news is that these are the sort of things you would want to see. Now, even in normal times, if there's such a thing, you don't always have the quote-unquote risk-off assets do well in a risk-off environment, and vice versa. There is a lot of cross-currents at any time, but of course, the last 2 or 3 weeks have shown major dislocations where things just didn't work the way they're supposed to, and that may well have had to do with severe deleveraging, forced liquidations, and things like that. As we continue on in this, there will be a normalization of that. Now, normal is in the eye of the beholder, of course. The one thing that we've learned from the financial crisis is that policy response can be dramatic, and notably, they can change the rules along the way. Certain things should have happened, and then the Fed comes in and guarantees lots of things. So policymakers change the laws and whatnot. That makes it very difficult to make rational decisions, and in my view, is also not good for capital allocation process. Now, the good news is we kind of know what policymakers are up to these days and what sort of things they throw at it. One thing I've mentioned before and would like to point out again, the Fed cannot increase the supply of treasuries. They can increase reserves. And what that means is that they can foam the markets, lubricate things, but ultimately the amount of treasuries is not changing, and so they can also try to provide an assurance that they will step in on certain areas, but that is very different from providing a government guarantee across other assets. And that also means, of course, that the bazooka can always be increased by providing precisely such a guarantee. We finally see swap lines being activated, 200 billion, I believe, is being given, and to, I believe it's the ECB mostly, and so They were slow to start. I haven't looked into it more precisely. It might be a reporting time issue, but more likely it is because there's a premium to be paid to access those lines, and so there's a reluctance on that. Also, many of these programs get fine-tuned over time, and fine-tuning means that usually the premium that is paid is adjusted to market conditions. Let's briefly talk about the policy response. The $2 trillion package is obviously still in Congress. The Wall Street Journal had an editorial criticizing that there will be workers that will be making more money when they're out of work than if they were to work, providing a disincentive for them to go back to work. And they obviously already preempted saying, hey, anybody will say that this is kind of cruel, we need to help people and so forth. And so let's differentiate here a little bit between the economic incentives, so to speak, versus the human hardship. Clearly, policymakers have decided, and maybe rightfully so, to provide support. But in order to get an agreement, and mind you, the Senate voted unanimously, and obviously one of the reasons they wanted unanimous is because they wouldn't have to come in person. The House, who knows how that's going to play out. But in order to get a unanimous consent, of course, you need to throw in the kitchen sink, to use that overused term, to get agreement, which means you're going to get Republican policies plus the policies of the Democrats. And speed is important, perfection is not important, and you get things like there might be, Wall Street Journal argues that some folks might get $35 an hour. Didn't verify that. That's in Massachusetts, they claim, where apparently unemployment benefits are otherwise quite good already. Needless to say, this whatever policy they agree on, it's not going to be perfect. And yes, it will impact how people will get to go back to work, how this will be phased out, and so forth. There are sunset provisions in these bills, 4 months, I believe it is, and so that is part of the cost. But as we try to ramp the economy back up at some point on the tail end, those sort of incentives will matter. And indeed, a lot of regulations have been set aside. And as far as the long-term growth is concerned, it is those regulatory restrictions that might inhibit people to go back. Now, many people are saying, well, wait a second, this is not a problem. We have the problem of the day. And absolutely, that's of course correct. In the short term, a lot of cross currents. Let me just make a kind of a broader comment here. There will not be a perfect policy response. And that's, let's take President Trump aside, whether you love him or hate him and whatnot. Globally, we cannot have a coordinated response. And even the US, we got 50 states, we got 50 governors, and it is all but impossible. What that means for practical purposes is we need to have tailored solutions. We need to have tailored solutions that work in an environment that is not coordinated. And so the state of California is going to need to think about what they need to do, the government needs to do in order to protect the state and how to kind of interact with the other states and so forth. Same with Texas or New York or any other state. And clearly there will be some states better equipped. Louisiana, I'm concerned about. They historically haven't been that efficient at dealing with crises. New York obviously is completely overwhelmed. I'm also concerned about places like Puerto Rico. And so there will be places that are better equipped than others to deal with this. Clearly, and unfortunately, this has become a political issue, we need to figure out how to get back to work. Now, this doesn't mean we'll go back to work in April. When President Trump says that, many people have pointed out it's quote unquote aspirational. I would agree with that. But Angela Merkel, Chancellor of Germany, also said it was premature to talk about it. Well, maybe it's premature to talk about it, but it is certainly not premature to start thinking about it. And in that, I guess the discussion to talk about it is valuable. We need to figure out how to do this. And quite frankly, the trillion or $2 trillion being spent and should have been emphasizing on how to get back to work. And that means how to get there safely. And everything now, of course, to get there safely. Yes, the shelter in place is necessary. Yes, the ramping of the testing is necessary. Getting all the medical workers properly equipped, but then getting testing for antibodies. Starting to instruct people how to behave in this world. Asians are used to wearing masks in public. We need to get used to those sort of things, and so there's a lot that needs to be done on that front. Let me shift here briefly to the gold market as I speak here. The spot gold is at 1621. There's the futures at 1647. That's the April contract. For first notice day where commercials can deliver gold is on the 31st of March, just a few days away. They can deliver until the end of March. This is the COMEX contract. Challenge in that market is that COMEX is a bit of an oddball. They use 100-ounce bars, 99% purity or better, 100-ounce bars for delivery. As an alternative, you can deliver kilo bars. The challenge is that the global standard is London good delivery bars. Those are the big James Bond sort of bars that people use. And so there aren't many of those available. And then on top of that, you have a difficulty in the logistics channel. You can't ship gold around easily right now. And then many of the refineries are shut, including the largest refineries in the world. And so that is a big part of the reason why you have this disconnect here between the spot and the futures price. One is used to those sort of disconnects in the oil markets and other things where you have more of these issues in the gold market. Many people are not used to it. But even spot gold is trading at a spread that is higher than usual, and so that's part of the challenge. On the physical gold side, in the London good delivery market, we talked to one major vault and bullion dealer. They say they're about 4 to 5 times as busy as expected during times of crisis, but are fully operational. And that's kind of what we see as well in other places. So the system is working, but yes, there are bottlenecks, and that makes conducting business more expensive. On the coin side, many of the coins, Maple Leaves in particular, are not available and so forth. And that's also kind of normal and expected in this sort of environment. And so these are kind of the normal stresses you see in the sort of environment that we're in. Let me talk briefly about the ETF world. And that's generic. I'll touch on the gold mining side here briefly, but it's more generic. Some ETFs during the peak stress period in the last 2 weeks have had much wider spreads. And I'm giving you my interpretation. Some market makers don't agree with that I've talked to during normal periods. But first of all, what people would agree on is any ETF trades as tightly as the market makers' ability to hedge themselves. Market makers are not in the gambling business. They build a hedge book at the end of the day, or whenever they, at the end of the day, once a day at the most, and that's relevant. They can go to the issuer and supply a basket of securities, or depending on the ETF, maybe a cash or gold ETFs, physical gold, and then in exchange they get shares. The challenge is that these market makers, they are just businesses like any other, and they have a limit of how much capacity they have, how much risk that they can take on. And during these extreme volume days, they had to take a step back. They said, we've reached our quota, so to speak. And so then they take a step back in our experience, and that's where some other market makers disagree with. But in our experience, with the exception of the truly largest ETFs out there, everybody prices their own spreads based on how the lead market makers prices themselves. So when the lead market maker steps away, spreads tend to widen more. That's one of the reasons why in the afternoons during the times of the panic, you'd seen that. And then the other issue, and that's been more widely documented, is that a lot of folks, or not a lot of folks, but a lot of volume at least, are placing market on close orders. That's insane in my view. It's just like using fixing for trading. You're using some artificial price. Well, the market maker steps aside. You say you want to get the closing price blindly. Well, guess what? You're going to get something odd, especially if there is a very heavy bias on one side. And levered ETFs depend on that as part of their design. To me, that's a huge design flaw. That doesn't mean the underlying ETF is broken, but you're not going to get the price of the underlying NAV if you want to trade at the close. You're going to get some ridiculous price. And so that's just some context there. Then, because I get a lot of questions about gold miners as well, they tend to be hit in a liquidity crunch, especially the smaller ones, because they notoriously need access to capital, historically speaking anyway, to fund the next phase of growth. They tend to be always funded for a little while. And so the key here, though, to remember is, yes, of course, if somebody needs to raise money in the current environment, it might be difficult. But if you have funding for the next 12 months, and many of the small companies may only have for 12, 18, or 24 months funding before they go back to the market, then these sort of companies can quite easily reduce their fixed costs. Many of them that are not producing, that's drilling holes, looking for gold, and then you drill fewer holes if you need to shut things down, right? And so it is not the end of the world for those sort of companies to get through this. Now, clearly, it depends on how this plays out, how long it will be. The mining operations, by the way, part of the reason they get suspended, if you have a modern mine, above ground mine, obviously people work in the big machinery. The challenge is that at night they sleep in usually on site in small sleeping quarters, and so they're close together, and that is part of the reasons why some of the mines are taking precautions. Now, many of these sort of principles, of course, apply to other businesses as well. I just happen to focus on this. Let me here briefly check whether I have any questions that have come in online. As I pointed out in the bottom here of this, you can submit a question at merkinvestments.com streaming. I don't see one. And so let me pause here for today. Let me again show you the wonderful disclosure if I get to that. Here we go. So you do that. Please tell me how and what you'd like me to do differently, whether you'd like me to expand this, cover different topics, have a different format. As we're providing this here as a quote unquote public service. Part of the reason I engage the public is because we do get feedback. It keeps us also thinking, consider perspectives, set us wrong. I, like anybody else, make mistakes, and sometimes I tweet something that's wrong, and you guys are very good at correcting me, and so that's very much appreciated. We try to stream this on Twitter. You also can see this on YouTube, and then at the URL here on the screen as well. And if you want us to stream simultaneously somewhere else as well, let us know. That is technically possible. All that said, stay safe out there. Have a great weekend. Take care of your family, and talk to you soon.